Good day and welcome to the Magpie YouTube channel. My name is Anthony Tran and I'm a strategist at Magpie Invest. Today, we'll be discussing the current rally in Japanese stocks and whether it may be a good time to consider them as part of your investment portfolio. In recent years, the Japanese stock market has been largely overlooked by international investors. However, it has made a comeback and has been one of the top-performing markets this year, drawing increased buying from foreign investors, including Warren Buffett's investment company. So, what's driving this renewed interest? There are three main factors at play. Firstly, after decades of underperformance, the Japanese stock market currently offers good value compared to the US market. Secondly, the depreciation of the Japanese yen against the US dollar has improved the international competitiveness of Japanese companies. And thirdly, Japan is benefiting from heightened Sino-US tensions, which have caused many international investors to diversify away from China. Without further ado, let's dive deeper into the first factor, valuations. The Japanese stock market is currently trading at a price-earnings multiple of 14 times, which is well below its long-term average. In comparison, the US market is trading at a PE of 23 times, which not only exceeds its historical average, but also more expensive than Japan. This attractive valuation has led many institutional investors to recognize the good value of Japanese stocks and start to buy them. Another driver is the weaker yen. The significant weakening of the yen against the US dollar in 2022 has boosted the global competitiveness of corporate Japan. Although the yen has made a modest rebound in 2023, it remains relatively inexpensive due to low inflation rates in Japan when compared to the United States. This gives Japanese companies an edge in global markets. In addition, investors have identified Japan's semiconductor industry expertise as an attractive destination for foreign investment, putting Japan in a favorable position to benefit from the escalating tensions between the US and China. In a recent meeting held in Tokyo, Japan's Prime Minister met with major heads of chip makers, including TSMC, Samsung Electronics, Intel, and Micron. During the meeting, they outlined plans to expand their business in Japan, potentially transforming the country into a semiconductor powerhouse. However, it's important to note that Hong Kong and US dollar-based investors need to be aware of the potential loss from a weaker yen when they convert their returns from Japanese equities back to their local currencies. The Japanese equity market, as measured by the Topix index, is performing very well in 2023, gaining more than 21% year-to-date. However, when measured in US dollars, the return will be down to just 12% due to the weakened yen. One solution is the iShares currency hedged MSCI Japan ETF HEWJ, which is designed to mitigate currency risk for Hong Kong and US investors.
With HEWJ, Hong Kong dollar-based investors can invest in Japanese equities with reduced impacts of currency exchange rates.
In summary, investing in Japanese stocks can be compelling.
With currency hedging, investors can access the Japanese market with reduced foreign exchange impacts.
Thank you for watching. I hope you enjoyed this video. See you next time.